Well, good morning, ladies and gentlemen. We're going to take a look at what's going on around the world, focusing in here on the market in Asia Pacific. And later on, I have a panel of distinguished friends and colleagues who I hope you're going to store up some very interesting and challenging questions for. It really is no exaggeration to say that particularly in the UK, but increasingly across Europe, IPD really has transformed the landscape in terms of the way investment managers benchmark their performance and in terms of the way in which the real estate community is able to look at and analyse real estate because of the work that they've done. And the Pan-Asia Returns Research is one of the early attempts from IPD to extend their services into the Asia market and provide some very interesting insights into how returns are coming together and how the market's performing relative to other regions and to different countries.
It's a great pleasure to be here this morning to launch the third edition of IPD's PARR, the Pan-Asia Return Research. So let's look at the actual returns that we've generated. Of the 6 runners-up, Indonesia was the highest, with 15.2%, and Japan had the lowest returns. You can see that there is something very obvious that all 3 markets have in common, and that's clearly that they are all markets in one way or another very closely associated and influenced by China. In third place was Taiwan with a return of 16.4%. China mainland was actually second with a return of 18%, and it was where we are today, Hong Kong, that had for the second year in a row the highest total return at 22.3%. Asia, in global terms, performed very well indeed. In 2011, it was retail property that was the best performer with a return of 11.2%, followed by offices at 7.5% and industrial property. And how is Asia compared with other regions of the world? Again, the Pan-Asia return represented by the bar. The return from United States real estate back on a local currency basis is represented by the blue line. Although US real estate over the last 2 years has actually quite significantly outperformed the Asian basket, most of that performance was actually a rebound from the disastrous years of 2008 and 2009, so that over a 5-year period, the US real estate performance at just 2.3% is significantly below Asia. The same is true, but slightly less volatile, of the European market.
What we want to do now is just focus on what's happening out there in the markets right now. What we see happening in property at the moment is very, very much being driven by the big macro events that we see in the world. From an economic point of view, it certainly is true that Asia Pacific and certainly China have been showing stronger economic growth than most of the rest of the world. The bars here in blue are global GDP growth, and you can see the green line for Asia Pacific is well above that line. That Still, we hear leading to discussion about so-called decoupling, the fact that Asia is capable of somehow moving on its own and is therefore not going to be impacted by what's happening elsewhere. I think that the bottom graph here really reveals that for what it is, which is simply untrue. I would argue that far from decoupling, the world's economies have never been more joined up. Investors remain very nervous, they're generally very risk-off around the world. In that environment, prime property actually looks very, very attractive. The combination of being a real asset with a high proportion of embedded value in the land and the built real estate gives you an underlying security to real estate investments that is very highly favoured most of the time here in Asia, but is particularly attractive to investors right the way around the world at the moment. So around the world, what we're seeing is very, very strong investment demand coming through for prime assets, a focus on quality of building, quality of location, particularly the lease length and the covenant of the tenants, and preferably in the larger and more liquid markets where investors are able to trade in and out more easily. So what we're seeing is very strong yield compression, very strong demand, particularly in the global market. Since the onset of the financial crisis, global and international funds have consistently been net disinvestors in Asia. They've been selling more Asian real estate than they've been buying. In contrast, the dark bars are what we regard as Asian money moving around Asia, a lot of it going through Singapore. The major funds and the listed REITs in Singapore have been amongst the most active in the sector across the region. And what you can see is that they have been buying more real estate outside their own markets than they've been selling. A very marked shift in the pattern that we saw in the run-up to the global financial crisis, and for various reasons that we're happy to discuss later, a pattern that I think we could well see continuing into the recovery phase. So in conclusion, I think that we need to get used to this uncertainty that seems to have been around forever already. But I think that we face still a lot of uncertainty in the world, and that's going to remain the case. If particularly the European situation does manage to approach some sort of conclusion, and provided none of the other major concerns and issues that are out there actually go thermonuclear, then I think that at some point we're likely to see quite a material shift in confidence. When investors, and particularly occupiers, international occupiers, come out of this money hoarding, risk-off mode, we're likely to see quite a sharp bounce back in activity because their shareholders at the moment are happy for them to sit on cash earning no return because it means the company's going to survive. When we move out of that risk-averse environment, shareholders are very quickly going to expect companies to put that money to work. We think that that's going to lead to two things. Firstly, a significant resurgence in M&A activity, which particularly in this region, which could well provide a much-needed boost to the financial sector, legal firms and so on. But also in terms of occupier renewing expansion plans, looking again at this region back into growth and expansion mode. Although the outlook for the world isn't as rosy, I have to say, as I would like at the moment, and I don't think that we're likely to see any material recovery until the early part of next year, I do believe that when recovery does start to happen, Asia is going to benefit first, and it will benefit strongest, and it will benefit longest from the long-term upswing that we see around this part of the world. And as a result, I think we'll see more activity from international capital, certainly, but particularly Asian capital moving around the region again.
We may be in this new environment for a long time to come, and we've already been in this environment for a long time. But what we're actually seeing on the property side is that it is having an impact on the decisions of those parties that are looking to invest into properties in Asia, where their investment committees and boards are based in Europe or London.
What is occurring now is that a lot of owners are realistically wishing to have very long leases to create income, strength and protection. And what we've also noticed is that there's been a great deal of pushback from the occupiers. They don't want to have a 5-10-year lease. They want to talk about 3 years and opportunities to get out, particularly if they're a very large tenant.
Your conclusion that you thought that by the end of the year, beginning next year, there would be an inflow of capital coming into Asia, I think is probably the scenario which we underwrite. If you look at Asia over the last 5 years, I think there is a great shift in the perception of risk, which in general, big investors from Europe and from the States view towards Asia. The risk perception towards Asia, I think, has changed. That's one. Secondly, portfolios. Asia is becoming a far more important part of the global investment environment. China, real estate markets in China are growing. Japan, very large. So large global investors will need to make a portfolio allocation to Asia. And thirdly, growth. If you look at the last 5 years, global financial crisis, Asia, according to the returns, 6% growth over the full 5 year.
Good seminar. It's always good to hear from IPD. We're very supportive of the work they do in Asia and elsewhere, so it's always good to see that they're boosting the numbers. And it's always good to hear from Nick Axford as well. I thought he did a good presentation on the broad capital markets picture and some interesting discussion for the panel as well.
I found it very worthwhile, thought well orchestrated, good balance of the asset management side, capital market side, and the investor side. And I think a good, healthy, robust discussion.
The last part about looking at the assets, about the stock in Asia, which is apparently up for renewal. That's a new perspective. I think people don't talk about them much.
I thought the event was great. Covered a good amount of territory in terms of not only statistically what's going on in the region, but also some opportunities that may exist.
Very, very good. Always a breath of fresh air to hear Nick. He's got some pretty good ideas on how things are panning out.
I mean, key takeaways is while the rest of the world is going through some transition, especially in Europe, and while it may have some impacts on Asia Pacific, I think the general conclusions are that Asia Pacific will continue to perform. It'll be an attractive market for real estate investing and investors, and come next year we should see increased flows of money into real estate in Asia Pacific coming from offshore.
The broad economic picture was interesting to hear a real estate spin from Nick, and also to hear from Richard Vandenberg about his views on China, and particularly his comment that he thought that international or kind of ex-Asia investors would be back towards the end of this year, which will be good for us, good for everyone.
The perspective from Richard, I think, on China, which, if you think about it, is there. I mean, China remains growth, and despite all the stories we hear, there's still a lot of potential.
For us, we're investors in the market, and one continuing theme has been most of the investment coming from local players. I think it's going to be difficult for foreign investors, particularly with the cost of capital overseas, to come into the Asian markets and be serious players. So if you're going to invest in this market, you're going to have to deal with the local folks.
Key, I guess, is really what Europe's going to do to this part of the world, and how much of an impact it's going to have. And so I think the jury's still pretty much out on that one.